Hello and welcome to Alternative Design's presentation of the October product launch. I'm Tim Harding, Chief Marketing Officer at Alternative Design. I'd like to thank you for joining us today. Typically our product launch webinar is a little bit earlier in the month, but we got a little star-crossed, I guess, with October the 1st falling on my usual Wednesday webinar date, and we didn't have product last week. I was hopeful that we would get it, but the banks were a little bit tardy, so we're doing it today. Good news is not a whole lot has changed in the products from September, which is a good thing because I thought the products in September were exceptional. They're going to look substantially the same for the month of October, and that's also good news because next to April, October has historically been the second biggest month for CDs to roll over. We always have a great October, and we're expecting to have another one this year. In fact, even without the product launch, you folks have been turning in business left and right. So apparently the product launch webinar being a little bit late this year, or this month, didn't really deter you. As always, if you have questions during the course of the webinar or at the end, go ahead and type them at any time into the chat box on your control panel. And as always, I will respond to those questions at the end of the webinar. So feel free to type in anything that you have in the way of questions, and we will address them. Take a quick look at where CDs are, traditional CDs are nationally. According to Bankrate.com, the average yield for a one-year CD has gone up. It's gone up a whopping 1 basis point to 0.26%. That's the second week in a row we've had a big upturn. So less than, just right at 0.25% for a one-year CD. 5-year CDs, if you're willing to make that commitment, you can bump that 0.26 all the way up to 0.84. Still less than 1%, and heck, even 5-year jumbo CDs, even though they were up only to 0.88%. So it's important to keep in mind that nationally, at least the average nationally, might be different in your particular region, but nationally CD rates on traditional CDs still are floundering at pretty much historic lows, and this is really your competition. I mean, when you have products like I'm going to go over today that offer minimum guarantees that are significantly higher than a traditional CD, plus all the upside potential of being a market-linked CD, you're really on to something. I think the opportunities have never been better. I've never seen better products, and again, October is CD rollover month, so we'll have you get out there and start beating the bushes because I think there's lots of opportunities there. We're only featuring 4 products on our platform this month. If you have a special need, of course, we can always address those, but we felt like these 4, which have been our most popular, really do represent a good cross-section of products and address a number of different needs with your clients. You can see that the Bank of the West Commodities Income Advantage product at the very top is paying a 2.5% referral fee this month. The Goldman Sachs and the Barclays products are each paying a 2% referral fee, but the Goldman Sachs 8-year Momentum Builder product is paying you an extra 0.5 point. That also pays a referral fee of 2.5%. So not a big change there. A couple of products that will get you a little more revenue in your pockets, but nothing dramatic. So let's take a look at what we're offering this month. One commodities product. Commodities, of course, are not real popular right now based on their poor performance over the past couple of years, but that in fact might be one reason that you would consider getting into them again. The Bank of the West product, same as always, it's a 7-year commodity product, has a minimum guaranteed interest rate of 1% or a maximum of 7.25. It's linked to a basket of 5 individual commodities. These haven't changed much. In fact, these are the same as last month. Cocoa, coffee, corn, lead, and natural gas. And the way this product works is very simple. On the calculation date or the anniversary date, if all 5 of these individual commodities is equal to or greater than its initial sales price, then the client's going to receive the maximum payout of 7.25%. If one or more of those 5 commodities are negative, then the client will receive instead the minimum 1%. So it's an either or. They're either all not negative or one or more of them is. If none of them are negative, client receives the higher payout. If one or more of the commodities is negative for the year, then the client would receive the minimum of 1%. But a couple of things to keep in mind here. I mentioned just a couple of minutes ago that commodities have performed very poorly recently. But everybody knows you should what? Buy low and sell high. So now might very well be an opportunity to buy low on commodities. As you can see from this recent chart, they haven't been much lower than they are right now. So commodities, although not in favor right now, might very well be a nice play. Remember, you're talking about a 7-year turnaround time. The other thing to keep in mind is the worst that a client can do in this product, even if commodities don't perform at first, is get 4 times what a 1-year CD is paying them, that minimum guarantee of 1%. They can get better than the 5-year CD rate, and you've got the potential for that higher return of 7.25% in any given year. Now, just hitting it once or twice or even 3 times can have a dramatic effect on the total return on this product. You can see in the very top column here, or top line here, that if the CD only hits the maximum payout 1 year out of the 7, the average annualized return for over those 7 years is 1.89%. More than double what a traditional jumbo CD, 5-year CD is paying. And if you hit it twice, the average annualized return is 2.78. If you hit it 3 out of the 7 years, you miss on 4, your client's still going to earn 3.67%. So even though commodities are down, even though all 5 have to be in positive territory for this to pay the maximum, you don't have to hit it very often to get a very, very competitive return on an FDIC-insured, principal-protected, and guaranteed market-linked certificate of deposit. And this will be the only offering linked directly and solely to commodities for the month of October, but that's a trend that we've been seeing over the past few months anyway. Back to the equity-linked CDs, we of course are featuring the Barclays product linked to a basket of 10 individual stocks. Has a minimum annual return of 1.5%. That's up. That's up from last month. So you've got a product here that dramatically outperforms a traditional CD on its worst state. A 1.5% guaranteed minimum return is very, very attractive right now. Hard to beat in the traditional marketplace. Comes with a 5% auto cap and a negative 10% return floor. Now, of course, a quick refresher on how the auto cap works. It's actually very advantageous to the return. You take it in 3 steps. On the calculation date, or what we typically would call the anniversary date, we compare the initial share price of each of the individual stocks to the anniversary price. If the share price is negative, we credit each component with a negative, but not lower than the floor. Remember, this product has a -10. So even if a stock goes down -30, for purposes of calculating the interest rate, it can't be worse than a -10. If the share price difference is not negative, in other words, if it's equal to or greater than its initial share price, each component will get credited with the cap. And then we add all of those together, all of the share price differences, the caps and the negatives down to the floor, and divide it by the number of stocks in the basket. In this case, it would be 10, and that average would give you the interest rate credited for that year. Now, once again, keep in mind that that 1.5% minimum guarantee is the worst that they could do in this product, and that's 6 times a 1-year CD rate, almost 2 times what a 5-year CD would pay, and you still have the upside potential up to that cap of 5%. So Great product here, especially for your more conservative clients who are looking for higher minimum guarantees. Lower cap, but higher minimum guarantee. And then we have two products that are substantially the same this month. The multi-asset Momentum Builder from Goldman Sachs. And I've been talking about this product over and over because I think truly it is one of the most attractive products we've ever put on our platform. It's a 7-year annualized point-to-point or 8-year annualized point-to-point, linked not to one asset class but to 7 different asset classes with 14 different components. You get a 100% participation rate in the index with no cap. The 7-year product, the 7-year version, pays an annual interest of 1% minimum, or the index return, whichever is higher. Once again, that 1% is quite competitive. The 8-year pays a little bit higher minimum guaranteed return of 1.20%. So that 1 year gives them a bump of 0.2% on the minimum guarantee. But as you know, because I've talked about it over and over, this particular product is a real performer, and we've had some nice returns. I'm going to update you on the returns through last month in just a moment, but you've seen the returns before because I keep showing them to you. This is a rules-based index, which means unlike many of the products that the banks put out, this one can be back-tested, and we can see what historical performance would have looked like. The key thing here, the key selling point on this particular market-linked CD, of course, is that it's multi-asset. It's spread over 7 different asset classes, developed markets, emerging markets, bonds, alternatives like real estate and corporate debt, commodities, and of course money market and U.S. bonds. This gives the portfolio a nice balance, and we know that over 90% of a portfolio's total return is determined by the asset classes within that particular portfolio. So what you've got here is essentially an immediate portfolio. It's not linked to one asset class. It's linked to 7. I mentioned a little bit earlier, it's a rules-based index. It's based on momentum theory and modern portfolio theory. And most importantly, it rebalances each and every month, which makes this a dynamic index, an index that isn't passive, like being linked to something like the S&P 500. This is an index that rebalances each and every month. It's dynamic, it's changing. The rebalancing process is really pretty straightforward when you take a look at it. Each month, through computer simulations, they test all of the possible portfolio combinations of those 14 different components. They throw out the ones that have a volatility of in excess of 5%, and then they find the best combination based on the math for the coming month. They choose one on what is referred to as the modern portfolio theory efficient frontier, where you're getting the maximum return for the minimum amount of risk. And that's the allocation for that month. And as I've said before many times, you can see the results. Going back here in this chart to 2005, you can see the red line there in the center, slow and steady, low volatility, outperforming each individual asset class because it's spread over 7 different ones. Returns historically have been very, very good. I've pointed out over and over again that there's only one negative year in the past 10, and that's 2008, when the stock market was down by 50% from its peak to its bottom. This index was only down 1.36%. You can see if you look at the top line for 2014, we took a step backwards in the index in September. We had a negative 3.4 for the month of September, which cut into the returns that had been looking really nice up to that point. So on an annualized basis, the year-to-date, 2014, this index is up 3.89%, which when you put it in the context of the returns on traditional CDs is actually quite attractive. Now, what is the explanation for this downturn in September? Well, I can't give you a precise explanation, but you can look in this report and see how individual asset classes have been doing. And if you take a look across that top line there, where it says effective performance 1 month, you can see it's not been a good month for virtually any asset class. The index is down in that month, 3.4%. But so are U.S. bonds, so are global equities, so are commodities, so are currencies, so is real estate. So even though this is spread over multiple asset classes, you're looking at a month here where everything pretty much went south a little bit. But keep in mind, year to date, it's still up. You can see the 6-year performance is 3%. 6-month performance is up 3%. The effective performance for 1 year, it's up over 7 still, even with that negative month. And so you've got a product here that is really an all-weather product that's going to get decent returns, if not extraordinary returns, at least decent returns on an ongoing basis. The product, I call it annualized point-to-point, is as the calculation methodology for determining the interest. Simply put, you're going to go point-to-point from the initial share price of the index to the price on the anniversary date and divide it by the number of years, and that interest is paid annually. So, for example, if it's up 10%, at the end of the first year, you take the 10% gain divided by the number of years. That would be 1. The interest payment for that year to the client would be 10%. You take at the end of the second year on that anniversary, if it hasn't gone up at all, you're going to take 10% and divide it by 2 because it's now been 2 years. So the client's payout in year 2 would be 5%, even though it didn't go up any further after that. So fairly simple calculation methodology once you get your arms around it. Sounds a little odd at first, but one of the main reasons it's done this way is to avoid the potential for phantom income. A 7-year point-to-point product that doesn't pay interest until the very end. There are a number of products like that out there available. The IRS is undecided as to whether that's phantom income and tax must be paid as you go, or if you can, in fact, wait till to the very end when interest is actually paid. So since the jury is still out on that one, this new methodology answers the question. It solves the riddle by actually paying out interest on an annual basis and still retaining that essential point-to-point concept. We avoid any question of phantom income. Cutoff dates for the month of September. We got Friday, October the 24th for the Bank of the West commodities product, and then Monday, October 27th for all but the 8-year Goldman Sachs product. The 8-year Goldman Sachs product Momentum Builder version cutoff date is extended to Tuesday, the 28th. So little time left to play. I apologize for the later than usual product launch, but it's some good stuff and it's a good month for rolling over CDs. So with that, I'll be happy to take any questions that you might have. As I mentioned at the very beginning, not a whole lot of dramatic changes from last month. So you should be pretty familiar with these by now. Gil has a question. How do the numbers you show compare to the GSMB MA5 multi-index? Okay, those are the numbers, Gil. That's where they come from. They're from that index. You can check this thing daily if you like. If you like, and your business consultant will always have the most recent updated report available for you, but the numbers I'm showing are the actual index numbers, and so you can look it up. You can look at the ticker and you can watch it minute by minute if you like. I'm not sure what the Bloomberg symbol is, but you can find it there, and if you do a Google search on the Goldman Sachs Momentum Builder 5, you would be able to track that on an ongoing basis. Question from Lenny: can we get copies of the slides? Some of them yes, some of them no. Lenny, if you'll just send me a quick email indicating which ones you're interested in, I will let you know. Some of them are copyright protected and I can't widely distribute them. Others, I've thrown together and I'm more than happy to share those with you. question from David. Does the money gained in year one compound in the following years or just the initial deposit? No, David, the interest does not compound. It is paid out. It cannot stay in the CD. It can be put back to work by purchasing additional new CDs in $1,000 increments, but it does not automatically compound inside the initial CD. Only the initial deposit is earning interest. Okay, as I mentioned, pretty much the same story as last month, but it's a good story. Excellent products this month. We're off to a good start. If we can help you here in any way, shape, or form, don't hesitate to give us a call. We'll do anything we can to help you with a MarketLink CD sale. So with that, I'll be back next week, same time, same place, 11:35 on Wednesday, Pacific time. Until then, have a great week.